Hello everyone and welcome to my channel, Compliance Lookup. In this video, we will be learn about the different country risk. If you have not watched earlier lecture, then watch it first. These topics are essential for financial security, and in future videos, we'll dive deeper into how these procedures are implemented, the tools used, and the real world impact they have on businesses and individuals. If you found this video helpful, don't forget to like, share, and subscribe for more content on financial compliance, regulations, and more. Now let's start what country risk is. Country risk and money laundering refers to the risk posed by certain countries when it comes to money laundering activities. It involves understanding the factors within a country that can increase or decrease the likelihood of illicit financial activities. Two key components are the financial regulatory regime and the social criminal environment. We will explain in details one by one. First is financial regulatory regime. This refers to the strength and enforcement of a country's financial regulations and anti-money laundering policies. Countries with weak or ineffective regulatory regimes are at higher risk for money laundering activities. Example: consider country A, where the financial regulatory authorities do not have stringent know your customer or anti-money laundering procedures in place. In this scenario, criminals may find it easy to use banks or financial institutions to launder money because there is no strict requirement to verify customers' identities or monitor suspicious transactions. As a result, country A presents a high country risk for money laundering. On the other hand, country B has strict financial regulations, including robust know your customer process, continuous monitoring of financial transactions, and active enforcement agencies that ensure compliance with international AML standards. This lowers the money laundering risk associated with country B. Second is social criminal environment. This refers to the general socio-economic and criminal landscape of a country. Countries with high levels of corruption, organized crime, drug trafficking, and weak law enforcement typically pose a higher risk for money laundering. Example: imagine country C, which has a high crime rate, is known for drug trafficking, and has widespread corruption in government institutions. This environment makes it easier for criminals to conceal illegal funds and launder money through local businesses, banks, or even property investments due to its social and criminal challenges. Country C is considered a high risk jurisdiction for money laundering. Conversely, country D has a stable social environment with low crime rates, strong anti corruption policies, and efficient law enforcement agencies that target organized crime. This lowers its attractiveness for money laundering, making country D a lower risk country. Creates practical implications. When businesses or financial institutions assess country risk, they look at these factors to determine whether they need to apply enhanced due diligence when dealing with customers or transactions from high risk countries. For instance, if a bank is considering opening a branch in country A or country C, it would likely apply stringent AML controls to mitigate the increased risk of money laundering. Now, coming to our second topic, countries deficient in AML regime FATF. The Financial Action Task Force identifies countries with weak anti-money laundering measures and monitors them through two main lists. First is high-risk jurisdictions subject to a call for action, which are blacklist. Jurisdictions under increased monitoring, which are grey list. Let's break down each aspect. 1. Country review by FATF. The FATF conducts reviews of countries' ML regimes and assesses how well they comply with international standards. The review examines are the strength of laws against money laundering and terrorism financing, enforcement capabilities, the country's cooperation with international efforts. Countries that fail to meet FATF standards are placed on either the grey list increased monitoring or the blacklist subject to countermeasures. 2. High risk jurisdictions subject to a call for action blacklist 4th March 2022. These are countries that have significant deficiencies in their AML and combating the financing of terrorism systems and FATF urges its members to take specific countermeasures when dealing with them. Real example: North Korea and Iran are two examples of countries on the FATF blacklist as of 4th March 2022. First, North Korea. The country is blacklisted due to its lack of effort in combating money laundering and terrorism financing. The FATF has urged countries to apply enhanced due diligence and even consider ending relationships with financial institutions operating in North Korea. Second, Iran. Despite some progress, Iran remains on the blacklist due to the incomplete implementation of its AML CFT measures. 3. Jurisdictions under increased monitoring grey list 4th March 2022. Countries on the grey list are not as high risk as blacklisted nations, but they still have deficiencies in their AML CFT systems. The FATF works with these countries to improve their regimes. While on the list, they are closely monitored. Real example: Pakistan was on the FATF grey list 4th March 2022. Pakistan was listed for insufficient MLCFT controls and was required to make improvements, especially regarding terrorism financing. The FATF monitored the country's progress and guided its reforms. In October 2022, after Pakistan made significant progress, it was removed from the grey list. Other countries under increased monitoring on this date included Turkey and Philippines due to shortcomings in their ability to effectively tackle money laundering and terrorism financing. Practical implications: blacklisted countries face severe restrictions. Financial institutions may avoid doing business with them altogether or apply enhanced due diligence to mitigate risks. Coming to next point, grey listed countries are given a chance to improve, but financial institutions are cautious and may still apply enhanced scrutiny when dealing with them. In both cases, businesses and financial institutions need to adjust their AML strategies to minimize exposure to risky jurisdictions. Now, coming to our third topic: countries under UN embargo. When a country is placed under a UN embargo, it faces international sanctions that restrict trade, economic activities, and diplomatic engagement. These embargoes often result from concerns about human rights violations, terrorism financing, or other illegal activities like arms trafficking. Countries under a UN embargo pose a high risk for money laundering and other illicit financial activities because financial institutions have to implement enhanced due diligence when dealing with these countries. The restrictions create challenges in tracking and regulating financial transactions, increasing the risk of illegal activities. Let's explain this with real examples. 1. North Korea. Unembargo reason: North Korea has been under UN sanctions due to its nuclear weapons development and continued ballistic missile tests, posing global security threats. Coming to its risks. Due to these sanctions, North Korea uses illicit financial networks and tactics like smuggling, cyber attacks, and cryptocurrency theft to fund its regime. Financial institutions dealing with North Korean individuals or entities face significant money laundering and terrorism financing risks. Is practical example: North Korean businesses or financial transactions are subject to enhanced scrutiny, and many banks are prohibited from offering services to them. For instance, in 2017, several North Korean banks were blacklisted by the UN, and international banks were advised to freeze assets linked to these banks. 2. Coming to Iran. It's an embargo reason. Iran has faced embargoes due to concerns over its nuclear program and alleged support for terrorism. Although some sanctions were lifted after the 2015 nuclear deal, many still remain, especially in relation to its ballistic missile program and regional activities. Coming to its risks, Iran's restricted access to the global financial system increases its reliance on informal networks to move money, making it a high risk country for money laundering. Illicit activities such as front companies and underground financial networks are commonly used. Its practical example. In 2019, FATF urged countries to apply enhanced due diligence to Iran due to its continued deficiencies in combating money laundering and terrorism financing. Financial institutions dealing with Iranian entities have to be extra cautious to avoid violating on sanctions. 3. Coming to Syria, its UN embargo reason. Syria has been under sanctions since 2011 due to human rights violations and the ongoing civil war. Its risks. Due to these sanctions, the Syrian regime and its allies engage in smuggling, black market trading, and using third party intermediaries to evade restrictions. The war torn environment increases the risks of corruption and illicit financial flows. Its practical example. Any bank or business dealing with Syria or its connected entities must ensure they are not violating sanctions, as many Syrian financial institutions and individuals are on international blacklists. Now, coming to practical implications of one embargo countries. First is increased due diligence. Businesses and financial institutions must apply stricter checks and controls when dealing with countries under embargo. Second is risk of legal violations. Engaging with embargoed countries can lead to severe penalties, including fines or blacklisting of the institution itself. Third is use of alternative networks. Countries under embargo often turn to illicit financial networks or cryptocurrencies to bypass restrictions, further heightening the risks for financial institutions. In summary, countries under UN embargo pose high country risk due to their restricted access to global financial markets and reliance on illicit means to engage in international trade. Financial institutions need to be particularly cautious when handling transactions involving these nations to avoid exposure to money laundering or violating international sanctions. Now, coming to our fourth topic. Country under sanctions by US, UK, European Union. Countries under sanctions by the US, UK, and European Union face various financial and economic restrictions, affecting their ability to engage in international business. These sanctions are imposed for reasons such as terrorism, human rights abuses, or nuclear proliferation. Financial institutions must exercise caution when dealing with these countries due to the risk of violating sanctions regulations, which can lead to heavy fines and penalties. Let's look at real world examples of sanctions by the US, UK, and European Union. First, I will discuss US sanctions. The US Office of Foreign Assets Control administers and enforces economic and trade sanctions based on US foreign policy and national security goals. Real example Venezuela. Its reason. The US imposed sanctions on Venezuela due to concerns about human rights abuses, corruption, and the undermining of democracy under President Nicolas Maduro. Its risks. US sanctions block the property and interests of the Venezuelan government in the US and prohibit US citizens from engaging in transactions with sanctioned Venezuelan entities or individuals. Its practical example. In 2019, the US placed sanctions on Venezuela's state-owned oil company PDVSA, restricting its access to the US financial system. This affected Venezuela's oil exports, and any US company doing business with PDVSA faced legal penalties. Coming to second, UK sanctions. The UK Office of Financial Sanctions Implementation OFSI handles the administration of sanctions, especially after Brexit, ensuring compliance with global security goals. Real example is Russia. Its reason. The UK, alongside its allies, imposed sanctions on Russia due to its annexation of Crimea in 2014 and the invasion of Ukraine in 2022. Its risks. Sanctions target Russian individuals, entities, and industries, including energy, defense, and finance, preventing UK businesses from engaging in transactions with sanctioned entities. Its example. Following the 2022 invasion of Ukraine, The UK imposed sanctions on major Russian banks such as Burbank and VTBB Bank. UK businesses were prohibited from providing services to these banks, freezing their assets and cutting them off from the international financial system. Now coming to third sanctions, which is European Union sanctions. The European Union also imposes sanctions as part of its common foreign and security policy, in line with the EU's commitment to promoting international peace, security, and respect for human rights. Its example, Belarus. Its reason: the EU imposed sanctions on Belarus in response to human rights violations and the crackdown on civil society following the controversial 2020 presidential elections. Its risks: EU sanctions target key sectors of Belarus economy, including arms, energy, and tobacco, and freeze the assets of individuals linked to the government. Example: in 2021, the EU imposed sanctions on Belarusian state owned companies, preventing them from exporting petroleum products and potash, a key fertilizer ingredient, to the EU. European companies had to halt their trade with these Belarusian entities or face penalties for violating the sanctions. Practical implications of sanctions by US, UK, and European Union. First, enhanced due diligence. Financial institutions must implement strict measures to ensure they are not violating sanctions when dealing with sanctioned countries, individuals, or entities. Second, legal consequences. Violating sanctions can lead to severe penalties such as large fines, frozen assets, or being blacklisted from international markets. For example, BNP Paribas, a French bank, was fined $8.9 billion by the US in 2014 for violating US sanctions on Cuba, Sudan, and Iran. Third, business restrictions. Companies in the US, UK, and EU may face restrictions when trading with sanctioned countries or sectors such as oil, defense, or finance. For instance, US and European Union sanctions on Iran prohibit businesses from engaging in oil trade with the country. Coming to its conclusion, countries under sanctions by the US, UK, and EU face significant restrictions that impact their economy and financial systems. Financial institutions and businesses must navigate these sanctions carefully by implementing robust compliance measures and exercising enhanced due diligence to avoid engaging in prohibited transactions and facing legal consequences. Now, coming to fifth and last topic, risk categorization of countries. It refers to the process of evaluating countries based on various factors like political stability, economic conditions, regulatory frameworks, and social factors to determine the level of risk a country poses for financial institutions, businesses, or investors. Countries are categorized into different risk groups to help businesses and financial institutions assess the risk involved in engaging with these countries. There are typically three broad categories used to assess country risk: low risk, medium risk, and high risk. Let's break it down with real world examples. First, low risk countries. These are countries that have stable political systems, strong economies, robust legal and regulatory frameworks, and low levels of corruption. They present minimal risk for money laundering, terrorism financing, and other illicit activities. Example: Switzerland. Its reason for low risk. Switzerland is known for its stable political system, strong rule of law, robust financial regulations, and high transparency. It is a member of the Financial Action Task Force and complies with global AML CFT standards. Its risk level: low. Is impact. Businesses and financial institutions dealing with Switzerland face minimal risk of legal violations or exposure to money laundering or terrorism financing. Second, medium risk countries. These are countries that have relatively stable economies and political systems but may face occasional political instability, corruption, or weaker legal frameworks. There may be some concerns about the risk of money laundering or terrorism financing, but they are not as severe as high risk countries. Example: India. Its reason for medium risk. While India has a large and growing economy and has made significant strides in improving its MLCFT frameworks, there are still challenges like corruption, regulatory gaps, and regional security concerns. Its risk level, medium. Its impact. Businesses dealing with India need to conduct enhanced due diligence, especially in high risk sectors like real estate or remittances, but the overall risk is moderate compared to high risk countries. Third, high risk countries. These are countries that have significant political, economic, or regulatory instability, high levels of corruption, weak enforcement of laws, or are known for involvement in illicit financial activities like money laundering or terrorism financing. These countries may be subject to international sanctions or embargoes. Example: North Korea. Its reason for high risk. North Korea is subject to UN sanctions due to its nuclear weapons program and lack of cooperation with international financial regulations. The country is known for engaging in illicit activities including cybercrime, money laundering, and illegal trade. Its risk level is high. Its impact. Financial institutions and businesses must apply enhanced due diligence and are often prohibited from conducting business with North Korean entities. The country poses significant risk for money laundering and terrorism financing. Example is Iran. Its reason for high risk. Iran has been under heavy sanctions due to its nuclear program and support for terrorism. Despite some sanctions being lifted after the 2015 nuclear deal, many remain, and the country struggles with money laundering and terrorism financing risks. Its risk level is high. Its impact. Businesses engaging with Iranian entities must exercise extreme caution to avoid violating sanctions, and they face significant compliance and legal risks. Practical implications of risk categorization you can see on screen. First, low risk countries. Businesses can engage in regular transactions without significant compliance burdens. Second, medium risk countries. Enhanced due diligence is required, and businesses should monitor transactions closely for any signs of illicit activity. High risk countries. Transactions may be severely restricted or prohibited, and businesses must implement strict controls and compliance measures to avoid exposure to legal, financial, and reputational damage. Now, coming to its conclusion. Risk categorization of countries is essential for assessing the level of caution needed when doing business internationally. Businesses must adapt their strategies based on the risk level associated with each country to mitigate potential legal and financial threats. So, we have completed this chapter of country risk. In the next and last chapter of anti money laundering, we will learn about transaction monitoring and reporting. If you want to get update of this topic, then please press bell icon of this channel. Thank you so much for watching this video.